Hi everyone, my name is Elise and I am a part of the Exactly ESG committee. We are here today to learn a little bit more about ESG, so let's walk through a training. The purpose of this training is to educate and inspire Exactlians on the groundings of a framework called ESG. E for environmental, S for social, G for governance. I will be referring to each of these letters as pillars as we continue on in the training. We will first start by defining this framework, then highlighting the importance and value it brings to an organization, followed by diving deeper into what makes up each pillar, with relevant, real-time examples, and finally, closing with inspiring benefits and lasting impacts of the ESG framework. Let's define ESG. ESG is a framework that assesses the environmental, E, social, S, governance, G, factors of an organization by which a company manages those risks, opportunities, and societal impacts of these areas. ESG is not about adding more to a company's statement of values, but instead looking at how a company manages the ability to create and instill that long-term value in a rapidly changing world by looking at the environmental systems, social systems, and governance systems that it operates in. There is no universal categorization of the ESG content, and it depends on the industry, company characteristics, and business model of an organization. Through the process of what is called a materiality assessment, a company can be assessed on these three categories, identifying each area that applies specifically to that organization. Plainly, the question to ask is, what activities of the business fall under each pillar of E, S, and G? According to the Sustainability Accounting Standards Board, also known as SASB, software and IT services include energy management, customer privacy, data security, employee engagement, diversity and inclusion, and competitive behavior. Please see more below for a bit more about each of these areas. Now let's look into the history of ESG. Where did the ESG framework come from, and how did it evolve? Let's take a brief look at the high-level timeline of the evolution of the ESG framework. In the 1980s, EHS was developed based on the rising need for organizations to establish regulations that prevent incidences such as injuries, illnesses, and harmful environmental impacts, thus protecting the environment and maintaining the health and safety of the employees. For example, in 1984, over 500,000 people in Bhopal, India were exposed to a harmful gas that was a component of the pesticide 7. Many of these prior instances could have been avoided by simply using PPE gear, personal protective equipment. So, EHS, Environmental Health and Safety, includes practical steps and activities to avoid causing harm to people and the environment in which they work. It expands on the baseline requirements from entities like OSHA, DOT, and EPA. Let's shift to the 1990s. There was a high focus on reducing the environmental impact beyond legal requirements. So starting in the first part of the decade, the United Nations reported on climate change and warns that global temperature rise may be as much as 2 degrees Fahrenheit in 35 years. It recommends reducing CO2 emissions worldwide. In the 2000s to 2010s, we have what is known as CSR, also known as Corporate Social Responsibility. CSR focuses on the philanthropy and employee volunteerism to align social issues. Through these CSR programs, businesses would benefit society while also boosting their own brands. ESG provides a holistic concept that is related to competitive advantage, risk and reward management. It applies numerical figures as to how a company builds a diverse and inclusive board, treats their staff, manages supply chains, responds to climate change, increases diversity and inclusion in the overall company, and builds community links. So why is this important? ESG as a framework is a dynamic concept where the business of doing business is no longer just about business. Companies that are actively working to create more inclusive, equal societies and protect the environment are seen not only as more competent, but more ethical and more desired by the market. So it is good for people, good for the environment, and good for the business. According to Harvard Business Review, thousands of publicly listed companies around the world are now measuring, managing, and reporting on ESG issues. This is a relatively recent phenomenon, with most companies having initiated their ESG strategies in the last decade. In addition, investors are now more committed to integrating ESG issues in investment decisions and actively engaging with companies on ESG issues. The Principle for Responsible Investment now has more than 2,300 signatures that have more than $89 trillion in assets under management. ESG-related issues have significant financial, social, and environmental impacts, both positively if managed well and negatively if not. Listed below are a few ESG-related examples that poorly affected these businesses and subsequently had significant ramifications. I'll just name a few here now. In 2010, there was the BP oil spill. BP spilled an estimated 3.19 million barrels of oil, which had leaked into the Gulf of Mexico. As a result, received $53.3 billion in fines, cleanup costs, and local reparations. Another example, the lawsuit of Volkswagen 2015. Volkswagen was charged €27.4 billion in penalties for rigging 11 million diesel vehicles to pass emission tests. Please read a few other examples below for additional content on some of these ESG-related issues. These events resulted in a greater societal demand for transparency and regulation in each division of the ESG framework. Now, let's dive into each section equally.